Welcome to the risk control training module. Risk control is very important. In fact, without proper risk control, nothing else you do in Forex trading will matter. Nothing. Let's explore an example of improper risk control. If you start off with an account, say $5,000. You've got a $5,000 account, ready to trade Forex, you're excited, you jump into a trade, and the trade is risking $2,500. You should hear a big buzzer go off in your head that goes, bad trading idea. Bad trading idea. BTA, as we call them. If you do this, this means basically that it only takes 2 consecutive trades to take you completely out of the game. Our objective is not to be taken out of the game. Our objective is to set up a solid foundation and be able to survive the times when our trading methodologies aren't exactly in sync with the market and we end up having the inevitable losing trade, or trades for that matter. 2 consecutive trades, 3 consecutive losing trades. These are not unusual in Forex trading. And wrap your mind around that, because losses are a natural part of it. We'll talk more about losses as we go through live examples as well. Okay, so here we are in MetaTrader. We've got everything set up. We're talking about risk control. Okay, so what do we do to control our risk? Great question. What we do to control our risk is first determined by the trading system that we're using. Now, conservatively, many suggest that you risk between 1 and 3% of your available capital per trade. So, say we're in this screen and we're looking to trade the euro dollar US dollar, and we have $5,000 we're using as a standard here in this particular case in our account. So on one side of that, 3% would be $150. So what does that mean in terms of market movement? That's very important. So this is what we're going to do. We're going to go up to the 1 hour chart here, and we're going to maximize that chart. Then we're going to go up and we're going to zoom in just 1 touch. And you'll notice that now that we've maximized this chart, the other charts are maximized too, weekly and so forth. Okay. All right. Now, as a for instance, let's take a look at the weekly chart, and let's click on the zoom in here. I'll wait 1 moment while you do that on your chart. What we'd like to look at is market movement. We're looking at a candlestick chart setup here, and we want to look at market movement in order to get a feel for the types of risks in the different time frames. This is very important because, well, if we're risking 3%, we're risking $150. Well, quite naturally, we couldn't use a standard lot size of $10 per pip in the euro dollar US dollar, because, well, I guess we could, but that would be not very many as far as pips is concerned. It'd be a small move, in other words, basically. So we're talking about 15 pips, and giving the market 15 pips of room to move that's a scalping kind of setup. And if we're doing scalping and the trading system that works for it, then that's fine. But if we're looking for time frames, we're trying to evaluate which time frame we should trade in. And let me hold on one moment and clarify why I'm talking about time frames. Because the larger the time frame, like the weekly being the largest time frame here in our set of charts, the more room the market will need to move in order for it to go through its natural gyrations. Now, I'm going to pop here and we're going to go into custom indicators, and we're going to scroll down to ATR. And I'm just going to set that at 10. So set yours at 10 as well. Okay, what's going to pop up is this blue line down here. If you want to, we can make that blue line a little thicker, if I'm not mistaken. Will it give us an opportunity to do that? Yes, it will. Here we go. Colors. Doesn't look like it's going to give us an opportunity to make that thicker. That's okay. This is fine for our purposes. We'll take a look at the blue line then. Okay. So let's take a look at the values here as we're looking around. In fact, let's go up here, click on data window, and you'll see that our ATR, our average true range, is listed right here as we scroll along each of these weekly prices. Now, the average true range is the average of the true range, and the true range is described as the greatest of one of the three of the following: the difference between the current high and the current low, and that's commonly called simply the range. The difference between the current high and the previous close, or the difference between the current low and the previous close. Whichever one of those is greatest is the value that we'll get. Now let's take a look. Okay, we're on the weekly chart and we're looking at the average true range. And as you can see over here, 0.0252. And if we look at that, that's 252 pips. That one, 256 pips. 257. Again, we're looking at the average. If we come down to places like this, you see how big those ranges are. And over here, almost 600 pips. Big, very big. And that's, again, that's an average. So this is obviously going to be bigger than that, but we're averaging in those previous true ranges as well. You can see from this example that if you're trading on weekly charts, that you're going to need room for the market to move. Now, there's a few ways you can do this and give the market room, but with a $5,000 account, trying to trade a standard lot with a 15 pip stop is not going to work very well. It's not going to work very well. So what we're going to do here is let's go to a daily chart, for instance, and let's expand that. Okay, auto scroll brings us back, and let's do the same thing there. Let's go down and grab our average true range. We'll do 10 period. There we go. What are we looking at here? Okay. We're looking at some smaller numbers here. Looking at some smaller numbers, but we're still looking at the 100+ pip range, not the 15 pip range. You can see that's really something. So that's 100, 100, 100, 100. Okay, so let's move on to the next time frame, and we'll pull this down to ATR. Okay, here we go. Click on OK. We'll click that to expand that a bit. Okay. All right. There we go. We're looking at 60, 50. That's a big one there. Again, these are averages. 40. Okay, so this is looking a lot more reasonable for the type of trading we're talking about with regard to the type of risk control that we need. But this would still, even the 4-hour would be too much for trading a standard contract with a $5,000 account with a 15 pip stop. Again, adhering to the 3% rule. So we're going to move down to 1 hour, and we'll do the same thing as we did before. ATR. And I'm simply changing this to 10 periods for the sake of consistency here. Okay. All right, you see much more reasonable ATRs here. Okay, and the ranges perhaps that we're talking about, still not giving us much buffer room as far as that's concerned. But at least we see how the different time frames show us different ranges of price movement per bar. So let's close this down. Close down this window. You go back here. Now let's say that the trading system that we've chosen does use daily charts, and we want to trade using the daily charts. We see the sizes of some of those moves as we move along here. There's a few ways that we can control our risk. It depends on what the system is and what it dictates as far as the price movement is concerned. So for instance, if we are trading a daily system and the system has a stop loss of 100 pips, then we quite obviously can't use a standard contract for that, because that would mean that 100 pip risk that we're taking would end up being the 100 times the $10 per full-size pip. So that'd be $1,000. That $1,000 would be 1/5 or 20% of the total $5,000, and that would be too great of a risk per trade. So what we'll do is we'll trade the daily chart, but what we'll have to do is we'll have to scale our level of leverage as far as volume is concerned. So rather than going with one full-size contract, if for instance we went to something that was 1/10 of that size for our 100 pip stop, then it would put us right inside of our 3%. So let's go over the logic in this. The trading system, the one that is our virtual imaginary trading system that we're saying that we'd like to trade, uses daily charts and uses a 100 pip stop. We can't trade that using a standard size contract because it wouldn't take very many consecutive losing trades in order for us to blow our account completely out of the water. So what we do is the smart thing, and we scale down in order to still trade on the daily chart by giving the system the necessary amount of room. So rather than risking the $1,000 per trade, we're risking $100 per trade by setting ourselves up in this fashion. So the $100 per trade turns out to be 2% of our total account equity at the start of trading. This is fine. We're able to do that. We're able to trade on a larger time frame chart, be it daily, be it weekly, as long as we're inside of our risk parameters, not going outside of that 3% of account equity. Some people will go to 5, and actually the higher the percentage of your account equity you risk per trade, the greater probability of blowing your account out, the greater your risk of ruin, basically. Some people call that ROR. But as you can see here, we can control our risk with virtually any account size, as long as the broker that you're using allows flexibility in the size of the trades that you place. And as it turns out, we have good flexibility here in the size of the trades that we place. So that's good. That's good to know. I'm going to set this back to the standard. But that's basically some risk control guidelines in a nutshell. Now, if you go to smaller time frames, if say, let's pop this up, and let's pop, we're going to do that, and we're going to do this, and we're going to do this. Okay. All right. Now, we're looking at an extremely short time frame here. This is 5 minutes. Many people do scalp, and scalping is defined as grabbing a small number of pips, and small is relative, but for instance, 100 pips is not a scalp. So 100 pips profit is not a scalp by any stretch of the imagination. 100 pips is bigger than a scalp. 5, 10, 3, 7, 12 pips, that's scalping. So in here, as we're moving along, if you take a look here, if you're trading on a short time frame, small time frame, then as you look over to the ATR window there, we can look here too, you can see 11, 10, 10. So the market moves in a smaller range in a smaller time frame. So you can trade on a chart of this type of time frame and allow the market room to move with a smaller number of pips. So the objective is to be able to have a trade go profitably and not come back and knock us out of the trade by hitting our risk control measures. So we have to have enough room in there for the trade to move without just the regular noise of the market knocking us out of trades. We don't want to set our stop loss, which is our risk, This is the amount that we're risking, and say it's 100 pips for a certain type of chart. On a daily chart, if we set our stop loss to 1 pip, we would just get stopped out over and over and over and over and over and over again. So that makes a stop of that magnitude for that time frame pointless. So let's go back here to hourly, close the data window. That is a brief introduction to risk control, also an introduction to the wonderful scalability of Forex, which allows us to trade different lot sizes based upon the risk control that we need for our particular account size. Thank you very much for joining us in this module, and I hope you found this to be very, very helpful. Let me emphasize again that the most important thing you can do is to get control of your risk. Once you get control of your risk and you have the discipline to continue to control your risk, you will be miles ahead of Forex traders worldwide. Thanks again.